Dear students, today we are going to discuss very interesting topic in accounts, debit and credit. Most of the students are confusing about which one should be given debit and which transaction should be credit. So today we are getting a clarity of this debit and credit. Before studying the rule of accounting, a rule of this debit and credit, we have to understand what is the exact meaning of debit and credit. Debit and credit shows increase and decrease in accounts. Which account should be debited and which account should be credited may depends upon the nature of account. So the important points to be noted here is nature of account. Somebody is asking, what is debit and credit? We can say only debit means increase or decrease. Then what increase and what decrease? It will be assets, liabilities, expense, incomes. The left side of an account is known as debit side and the right side of an account is known as credit side. Normally we are saying this one. For convenience, we can use DR for debit and CR for credit. So we have to understand what is the nature of account. Then only we can say which one should be debited or which one should be credited. In order to study the nature of account, firstly we have to understand what is the meaning of account. Account simply means a formal record of the transactions. Formal record of the transactions under some common heading or common header. Salary account, insurance account, rent account, cost of goods sold account, all are accounts. So under this heading we can say each items are known as an account. In accounts, two types of approaches are there. One is English approach and the second one is American approach. As a student, basic knowledge for accounting should know these two approaches. American approach and English approach. Otherwise we can call as traditional approach and modern approach. First we can study what is a traditional approach. Under traditional approach, accounts are classified into three categories: personal account, a real account and a nominal account. English approach and a traditional approach is there. Modern approach or American approach is also there. Personal, the word personal means the accounts related with the persons or entities is coming under this heading of accounts. Personal account. The rule of the personal account is debit the receiver and credit the giver. Example, paid 1,000 to A. So who is receiving the money? A. So A is the receiver. So A will be debited. Debit the receiver and credit the giver. Personal account related to persons. Here we can, little more clarification is required. Persons include natural persons, artificial persons and representative persons. Three categories of persons are here. Natural persons, the name of the people. Representative people, landlord, outstanding, prepaid, etc. Artificial persons, institutes, companies, entities we can call as. All these are coming under the category of personal account. The rule of the personal account is debit the receiver and credit the giver. Number two, real account. Real account means reality items. Reality items means assets and properties. The accounts related with the assets and properties. Land, building, plant, machinery, furniture, cash, debtors, stock, etc. are the examples of real accounts. The rule of the real account is debit what comes in and credit what goes out. Debit what coming to the business and credit what is going out from the business. For example, you are purchasing a machinery. What is coming to the business? Machinery. So debit the machinery. This rule is known as real account. Number 3, nominal account. Nominal, the word nominal, only the name indicates the accounts related with the expenses and incomes. The accounts related with the expenses and incomes, or we can call as losses and gains also. The rule of the nominal account is debit all expenses and losses and credit all incomes and gains. Debit all expenses, rent, salary, insurance, postage, stationery, all expenses you can debit. And all incomes, income means commission received, rent received, any other items received, you can write as an income. So all expenses will be debited and all incomes will be credited. This is the classification under traditional approach. Look here, the rules of debit and credit. Traditional approach is there. Traditional approach is otherwise known as English approach. Personal account, real account, nominal account. Accounts related with the persons or entities. Debit the receiver and credit the giver. Second one, real accounts. Accounts related with the assets or properties. Debit what comes in and credit what goes out. But in nominal account, the accounts related with expenses and incomes. Debit all expenses and credit all incomes. We understand rules of debit and credit here clearly. So firstly, you have to identify which category is account. It is a personal account, you have to apply this rule. If it is a real account, you have to apply this rule. If it is a nominal account, you have to apply this rule. From this, what do you understand? Identification of account is the most important factor in order to study the rules of debit and credit. Simply somebody is saying debit and credit means debit what comes in, credit what goes out. No, the exact meaning is different. Debit and credit shows increase or decrease in accounts. So in order to study clearly the debit and credit, you should understand which account is that. If it is related to personal or if it is related to real or the nominal. So in a simple sentence we can say identification of account is the most important part to study the rules of debit and credit. Whenever you are receiving a transaction, you should have a clear knowledge about it is which account. If it is a personal account, if it is a real account or the nominal account, then think about that and which rule we can apply. These rules are known as the golden rules of accounting. So now you understand the English approach clearly. Most of the students are using English approach. But if you are going international level, out of the country or some areas, normally we are using American approach. Next we can discuss modern approach. Modern approach is otherwise known as American approach. Normally international level we are using American approach or modern approach. Under modern approach says that accounts are classified into 5 categories: assets, liabilities, capital, revenue and expenses. 5 heads of accounts are there. First heading they are saying assets. Asset, debit means increase, credit means decrease. Debit means increase, that means if asset is increasing, you can give a debit. If asset is decreasing, you can give a credit. Example, you are purchasing asset. What is increasing there? Asset is increasing therefore purchase of asset. This is the rule of which rule application? Debit what comes in and credit what goes out. So these both rules, modern approach and English approach, are closely related. English approach is saying in one way and American approach is another way. Both the meanings are same. They are saying only in different ways. They are putting increase and decrease ways. So here assets. In the case of assets, asset increase means debit. Decrease means credit. Number 2, liabilities. We know that liabilities are the obligations or the debt payable by an organization. Liabilities, debit means liability is reducing. Liability credit means liability is increasing. You are taking a bank loan, your liability is increased, therefore bank loan is credit. So under this heading, liabilities, debit means your liability is reducing. Credit means your liability is increasing. Number 3, capital. You know that is the capital. The amount contributed by the owner to start a business is known as capital. It is otherwise known as owner's equity. Under this account, capital, debit means capital is decreasing. Credit means capital is increasing. Number 4, revenue, or otherwise called as income. Under the heading revenue, increase means revenue is credited. Decrease means revenue is reducing. This is the rule of the nominal account. Debit all expenses, credit all incomes. So debit means revenue is decreasing and credit means revenue is increasing. Number 5, expenses. Expenses, the amount spent for earning income is known as an expense. Expense is increasing. Debit, rent paid, salary paid. Debit only. If expense is reducing, we can credit. So these are the 5 heading under the head modern approach or American approach. Look here. Modern approach or American approach. Assets, liabilities, capital, revenue and expenses. In the case of assets, debit means increase. Credit means decrease. Liabilities, debit means decrease and credit means liabilities increasing. Capital, debit means capital is reducing. Credit means capital is increasing. Revenue, debit means decreasing and credit means your income is increasing. In the case of expenses, debit means increase and credit means decrease. In short, in simple, we can say all expenses and losses always debited. All assets always debited. All incomes always credited. These are the 3 major important points to be noted whenever you are studying the accounts. All expenses always debited. All incomes always credited. Cash is coming, always debited. Cash is going, always credited. So whenever doing a transaction, you should have to understand these both approaches, English approach and American approach. Then you can identify the transaction, which one should be debited and which one should be credited. This is the most important and basic area of accounting. I think that all the students are clearly understand both approaches. Thank you.